What's up guys, welcome back to the Daily Stock Picks, and in this video we will be going over 4 Robinhood stocks that you should consider buying right now and holding it off into 2021. Make sure that you watch till the end of the video as we will be going over pretty amazing companies that have a huge growth potential, and few of these companies also pay a good dividend for all of those passive income investors out there. All I ask in return is that if you guys feel like being awesome, make sure that you smash the like button for the YouTube algorithm. I would really appreciate it. And without further ado, let's get this video started. The first company in this list is 3M, ticker symbol MMM. So 3M is an industrial and applied science firm. I won't lie, in recent years, 3M stock has struggled for relevancy, simply because that the business world has changed as it's continuously evolving day by day, year by year. Giant conglomerates like 3M were really confused and unwieldy, but that all suddenly changed when the new pandemic hit. People started to invest in more stable companies whose revenues and dividends that they can rely on. At the time of this recording, 3M is currently trading at a stock price of $164.38 per share, with a 52-week low of $114.04 and a 52-week high of $182.55. And coming to the price chart, we can see that over the past 10 years, the price has been appreciating in the positive direction. And we can see that back in somewhere around 2018, the stock was trading somewhere around $250 per share, which was its peak. And when comparing to the S&P 500 index over the past 10 years, we can see that the company has returned on an average annualized return of 9.89%, which has underperformed the S&P 500 index. During the same time frame, S&P 500 index has returned nearly 14.17%. But I think that the stock price is currently at a markdown, which is a great buying opportunity for all the Robinhood investors out there. And coming to its profitability, we can see that it currently has a return on invested capital of 17%. Anything which is above a 10 means that it is profitable, and it does have some sort of competitive advantage working in its favor. So what this number literally means that for every $100 that you're able to invest into the company is able to generate $17 as returns to its owners. And when coming to its revenue numbers, we can see that the revenues have been increasing in the positive direction along with its free cash flows. So free cash flows is basically the amount of money that the company is left with after paying out all the capital expenditures, and it gives a really good figure on the amount of cash flows the company is able to generate when compared to its peer, which is known as the net income. And it currently has a current free cash flow of $5.371 billion, out of which $3.316 billion is being paid out as a dividend. And if you were to calculate the percentage, you can see that it is paying out nearly around 62% of its dividends to its shareholders just for owning the stock. And the remaining 30-odd percentage amount can be reinvested back into the business by the management in order to increase its top line, which is the revenue. Looking at 3M's dividend history, we can see that the company has been increasing its dividends over the past 61 years. And it has been increasing this dividend at a rate of 10.94%, and it belongs to a unique dividend class paying stocks known as the dividend kings. 3M currently has a market cap of $95 billion with a price to earnings ratio of 18.65, which is undervalued when compared to the S&P 500 index, which currently has a price to earnings ratio of 29.14. On top of that, I like to see what the Wall Street analysts are currently recommending about the stock, where 1 being a strong buy and 5 being a sell. And the analysts are currently rating this company as a 3.2, which is a hold. And the average price target is $162.87, which is slightly lesser than the current price of $164.38. Looking at all these numbers, we can see that there's a lot of positives running for this old company with its recent articles about the year-over-year sales rise in July. And on top of that, they have also increased their dividends as well, thus making it into the stock recommendation list of many articles across the internet along with this video. The second company in this list is Home Depot, ticker symbol HD. Home Depot is the world's largest home improvement specialty retailer operating nearly 2,300 warehouse format stores, offering more than 30,000 products in store and 1 million products online in the United States, Canada, and Mexico. When the first wave of this beer flu situation hit, consumers naturally shifted their spending by purchasing the necessary goods like food, water, beer, and toilet paper. But most of the retail personal protective equipment, PPEs, are sold at hardware stores like Home Depot. Thus, Home Depot stock benefited from this panic frenzy, as well as the shares are continuing to enjoy positive momentum, and I believe that this will carry on into the next year. And on top of that, Home Depot's ship from store service is pretty impressive with speed and convenience, and I personally think that you should have in your portfolio. This thought process being repeated a million times over is what drives the case for Home Depot being one of the top stocks to buy. Home Depot is currently trading at a stock price of $285 per share, with a 52-week low of $140.63 and a 52-week high of $290.58. And looking at the price chart, we can see that Home Depot stock price has been increasing over the past 10 years in the positive direction. And if you were to compare it to the S&P 500 index, we can see that Home Depot has returned nearly 28.85% to its shareholders when the S&P 500 only returned 14.17%, nearly double the amount of S&P 500 index. So if you had invested $10,000 back in Home Depot, you would have made around $126,000 just by doing nothing. That's what I call passive investing. And in this case, both of the dividends that are being paid out by the S&P 500 and Home Depot were reinvested back into the companies. And coming to its profitability, we can see that Home Depot currently has a return on invested capital of 38.62%, which is an exceptional number for a company of this size. And the lowest that I could see was from back in 2010, where it was somewhere around 10%. Thus, still showing any number that is above 10% is a really good number to look at in terms of profitability. And looking at the revenues and the free cash flows, we can see that the revenues and the free cash flows have been increasing in the past 10 years in the upward direction, and it currently has a free cash flow of $11.04 billion in its cash flow statement. And when comparing it to the dividend, it's currently paying it out around $5.598 billion in terms of dividends to its shareholders, and this accounts to around 53% of the current free cash flows. And the remaining 47% can be reinvested back into the business by the management if they choose to do so. And looking at the dividend history, we can see that the company has been increasing its dividends over the past 11 years at a rate of 19.71% at a compounding annual growth rate, which is pretty impressive for all those dividend investors out there. So coming to its balance sheet, we can see that Home Depot currently has a total long-term debt of around $35.82 billion, which can be easily covered by the total current assets, which are basically the most liquid assets that can be converted into cash within a year, and that is accounting to $27.28 billion. Since it's not equating to the total long-term debt, I like to look at the current ratio for the balance sheet to see whether it can pay off its short-term financial obligations. And looking at its current ratio, we can see that it is around 1.17, meaning that it has nearly 17% more current assets when compared to its current liabilities. Home Depot currently has a market cap of around $306 billion with a price to earnings ratio of 28.30, which is slightly lesser than the S&P 500 index, which we've seen previously, which was around 29. Analysts are currently rating the stock at a 2.2, which means a buy, and the average price target is $278.42, which is slightly lesser than the current price of $285. And on top of that, crises happen all of the time. This year, we're encountering a record-breaking hurricane season. Next year, who knows what could happen. Likely though, the Home Depot will be around to help you, which is a good reason to trust Home Depot stock in your portfolio. So the third company in this list is Costco, ticker symbol COST. Costco is a leading warehouse club, and it has around 782 stores worldwide. And it is hard to believe that someone does not know about Costco by now. Me personally, I love the cheese pizza in the food court and the enormous value it offers for its customers. But the beauty of Costco stock is that it's a great name to have in your portfolio under any circumstances, since the average Costco member's annual salary is close to $100,000, and you can reasonably assume that its core customers are financially stable and working from home. Costco is currently trading at a stock price of $340.75 with a 52-week low of $271.28 and a 52-week high of $345.12. And coming to the price chart for the 10-year time span, we can see that the company's price stock has been appreciating in the positive direction, and it is currently trading at $340.76 as we've seen previously. And when comparing to the S&P 500 index, we can see that Costco has returned an annualized return of around 22.85% to its shareholders when compared to the S&P 500 index, which only returned about 14%. And coming to its profitability, we can see that Costco has a return on invested capital of 16.04, which is pretty phenomenal for a company of this size. And the lowest that I could find was somewhere around 10%. That would have been somewhere in the year of 2010 to 2012 timeframe. Looking at the revenues, we can see that Costco's revenues have been increasing in the positive direction, and the free cash flows, there were a little bit of returns here and there, as we can see back in 2017 and in 2016, but the current free cash flows is around $3.358 billion, out of which $1.038 billion is being paid out as a dividend. And if you were to calculate this by dividing 1.3038 divided by 3.358, this would equate around 30% of its current free cash flows, meaning that the remaining 70% can be reinvested back into the business. Looking at the dividend growth, we can see that Costco has been increasing its dividends over the past 16 years at a rate of around 15.28%, which is totally bananas. Looking at the balance sheet, we can see that Costco currently has a total long-term debt of around $9 billion, which can be easily covered by the massive current cash pile that it has in its current assets, which is around $25.25 billion, which is a positive sign to look at for its investors. Costco currently has a market cap of $150 billion, and the price to earnings ratio is 40.76, which is overvalued when compared to the S&P 500 index, which is somewhere around 29. The Wall Street analysts are currently recommending the stock as a 2.3, which is a buy, and the average price target is $340.58, which is around the same current price of $340.75. To be frank, Costco is no means any growth stock by any chance, where analysts are estimating that the growth for this company would be somewhere around 9.50%. And if you were to look at the next 5 years per annum, they're expecting an average growth rate of 7.15. But rest assured, Costco does pay a good amount of dividend, and it only accounts to 30% of its free cash flows, showing that the Costco will not be cutting down its dividend anytime soon, irrespective of the current environment. And it has one of the best balance sheets in the industry when compared to its peers. And the last and final company is Amazon, ticker symbol AMZN. Amazon is among the world's highest grossing online retailers with $281 billion in net sales and approximately $365 billion in estimated physical digital gross merchandise volume, GMV, in short, in 2019. Obviously, Amazon makes a list of many stocks to buy on multiple news articles. Amazon is a great disruptor and dominates any market that it enters because of the consumer data it has and the flexibility and the benefits that it offers to its shareholders and its customers. I believe that if you own Amazon, you can go to sleep comfortably knowing that you will have invested your money in the correct company with exceptional fundamentals, which we'll see in a couple of seconds. At the time of this recording, Amazon is currently trading at a whopping price of $3,312.49 per share. Yep, you heard it right, it's $3,000. With the 52-week low of $1,626.03 to a 52-week high of $3,344.29. Woo! That was really hard to say. Make sure that you smash the like button, guys. Looking at the price chart, we can see that Amazon stock has been appreciating in the upward direction and reaching its peak of around $3,312 recently. And when comparing to the S&P 500 index, we can see that Amazon has returned nearly 37.70% to its shareholders on an annualized basis when compared to the S&P 500 index, which only returned 14.17%. And coming to its profitability, we can see that Amazon has a current return on invested capital of 15.10%. Any number which is above a 10 shows that the company does have some sort of competitive advantage working in its favor. And we can see back in 2015 and in 2013, the Amazon's return on invested capital did go below zero, but rest assured, the current return on invested capital is a really promising number to look at. Looking at the revenues and free cash flows, we can see that it has been increasing in the right direction without that much fluctuations in its free cash flows, and it currently has a free cash flow level of $21.65 billion, and it does not pay out any dividends, meaning that $21.65 billion can be reinvested back into the business in order to increase its top line. And coming to Amazon's balance sheet, we can see it carries around $33 billion in long-term debt, which can be easily covered by the current assets in a jiffy if the management chooses to do so. Amazon currently has a market cap of $1.65 trillion with a price to earnings ratio of a whopping 127.22, which is no means a value pick, but investors are willing to pay a premium in order for the future growth potential that the company has to offer. The Wall Street analysts are currently rating the stock at a 1.8, which is a buy, with the average price target being $3,630.41, which is currently higher than the current price of $3,312.49 per share. Frankly speaking, Amazon's core contactless e-commerce business isn't going to go anywhere anytime soon. In addition, Amazon has its own AWS cloud platform, which has become critical as the nation quickly turned to work from home applications. And that's it, guys. Those are the 4 stocks that I believe that every Robinhood investor should consider buying. And by the way, full disclosure, all the stocks that have been discussed in this video are for your entertainment purposes only. Please conduct your own research before investing your hard-earned money into these stocks. If you guys have watched the entire video and reached till here, I really appreciate it, and catch you in the next video. Peace.